Okay, now we're having fun. We're gaining that understanding of the flow of accounts. Now, what about expenses and revenues? If we take a look above, we see that expenses fall under accounts that have debit balances, and revenues fall under accounts that have credit balances. So, for instance, if we have to pay rent, like most businesses, we will record the payment in the records as a debit to rent for, let's say, it's $1,000. And where do you think the credit will go? That's right, good old cash. You can't pay rent with much else. Then we'll show the debit in the T account for rent for $1,000 and the credit to cash for $1,000. Now we're going to assume that we had a cash sale. So the debit will be to cash since it was a cash sale, and we are increasing this asset. We'll assume it was for, let's say, $5,000. And so the credit is going to be to sales revenue or sales rev of $5,000. So we show sales credit of $5,000 and over here at cash for $5,000. Okay, so everybody's doing great so far. So what we have here in summary is basically these are all our asset accounts and expense accounts on the left side. And as you can see, they generally have debit balances. So when we increase them, it will be from a debit entry. And when we decrease them, it will be from a credit entry. Then these accounts are equity, liability, and revenue. We will increase them when we post credit entries. And when we decrease them, we will record debit entries.